What's going on YouTube? We're back again for another episode of Your Average Traders with me, Raj, and my brother Jason. It's another rip-roaring rally day today, similar to our last pod. And since then, we've had a bit of turmoil. We've had a lot of volatility. We've had some real pain in the market. But today, we've seen NASDAQ rise over 2% down. The E-minis are also up close to 2%. We've seen rallies in Europe. We've seen rates going up, oil going up. So it's been a rally across the board. So is this the start? Basically, as we approach the end of the year, is this a delayed Santa Claus rally? I mean, only time will tell. But we still have some of these headwinds that we spoke about in previous podcasts in terms of interest rates. And now we're seeing Omicron cases surging worldwide. What do you think? What do you...
Yeah, well, the latest fear is all about potential for more news and studies to come out about this variant, as well as the Delta and Omicron case surges that are going to inevitably hit over the next couple of weeks, which could also shape the market again. It really just depends on how the media choose to depict this. Right now you see quite a lot of renewed interest in buying the dip, especially after Biden's speech and his no mention of lockdowns. So yeah, it's actually a lot of things happening at once, as well as the recent Fed decisions to the planned 3 rate hikes next year. However, with the Build Back Better plan potentially not going ahead in its current form, could mean that we have potentially a lower inflation next year. And if that does actually occur, it could see potentially a low amount of rate hikes planned next year, especially if we get into a market which is slightly less inflationary or even potentially deflationary.
Yeah, I mean, you know what it is? It's a weird one because, I mean, it's all about you looking at how different parts of the world are dealing with this. I mean, clearly, this seems to be a bit more milder, but just the pure number of people that are getting it is just so much more. So the question is, you've got the Netherlands that have now just gone into a full lockdown. Europe are debating it as well. Boris Johnson has just pretty much kicked the can down the road, wants to see a bit more information. In the States, Biden can't do anything like that. There will be total carnage. Although, like you said, there are people pulling back some of the, these like Goldman Sachs cancelled, told all employees they had to cancel all Christmas parties. And, the hospitality industry, again, is the one that's bearing the brunt of it. But the question is, Build Back Better plan or not? I mean, if these same type of supply issues, if Omicron keeps on causing these issues worldwide, where we, like in the Netherlands, we are shutting down, we could get that same supply side issues, which has been basically the main root cause of this inflation. Supply side everywhere is an issue, and if we're going to have nations around the world shutting down, then we might just inadvertently just boost. We're trying to unclog that supply side shock, and now we're just going to resurrect it. So it's going to be very interesting going forward how this all develops.
Definitely. You have to put your heart out to everyone who's in the travel and leisure hospitality fields, whose livelihoods are going to be affected. Just going to central London, last couple of restaurants I've been to, have had a huge amount of cancellations. Last one I went to was completely empty, and usually it's their busiest period. Also in my app, which has 1.4 million monthly active users, right now I can see advertisers are pulling campaigns left, right, and center. It's kind of like the fear of early 2020 all over again. So
people have seen what happened last time, the reaction, and just sort of jumping the gun a bit. People were calling, definitely. I heard people calling today, but today we had such a broad-based rally. We had airlines up 7%, 6%. I think a lot of this was just short covering. Some of these names have been hit so hard. I mean, what have you been doing to sort of benefit or try to trade or navigate through this current market volatility? I mean, yesterday it was a pretty broad-based decline. Again, a lot of this market, we were just at all-time highs last Wednesday. But again, the indices are not really telling the true tale of what's going on behind these markets, as these big FANG names are pretty much, attributing to all the gains in the index. And we're seeing some of the Russell stocks just getting absolutely pounded. It's been very, very tough. Some of the names, a lot of tax loss selling as well as we were entering into New Year's, which might have been attributing to some of the quite big declines. But I mean, what's been on your radar? Like, what you've been looking at?
Well, you predicted it pretty correctly last month on what was supposed to happen. So I did take a bit of your advice and trim down my positions, but not enough. It seems.
Not enough, yeah. I didn't even listen to my own. I should have trimmed down more, Yeah.
Because, I mean, a lot of pain still, and had me awake at night, even though it's going to come back eventually, but it's just some of the option positions I was in with naked put selling, offside a bit, kind of just gets you on edge. But today with a nice rally, it seems to have righted itself. It kind of gets you into that position in your head to think, I need to develop a few more strategies to hedge myself, especially if renewed fears of Omicron start to emerge. Looking at it anecdotally, so many people that I know who have never had COVID or even had it before. Yeah. It's just like, oh, I've got COVID, I've got COVID.
Triple backs. It seems like a lot of people are getting it, but it does seem that they're all getting over it fine. And from most of the people that I spoke to, it just seems to be a pretty mild case, and hopefully that's just all it is, So,
So, what do you think? I think coming up in 2022, I think tech, especially big tech with big moats, are going to be good plays for 2022, especially if we go into the slower inflation or potentially deflationary environment. It really depends on the consumer, how confident they feel in this new year, and also in terms of stimulus. With the original COVID, we had a bucket load, but it seems like with inflation fears, no one really wants to be doing that now. I know in the UK, there's like $6,000 grants going out to restaurants and hospitality venues, but it's nothing compared to the huge bucket of cash and furlough they had.
The main difference is
last year.
In terms of monetary policy, it'll be very hard for these banks to give the same type of response as they did last time, especially with US headline inflation at 6.8%. I mean, it's obviously now we've had energy come down a bit, so it's going to sort of cool a bit, but you can't react in the same way, and that's why we saw the Bank of England as, first rate hike from a major bank, which was, I think, the right thing to do. It's still only 0.25, but no, I think next year will be interesting because, I mean, to be honest, this year it is a handful of massive large caps which have attributed to all the gains in the index. But if you actually look at it on an individualistic basis, like so many stocks are down 70% from Jan highs, 60%, 50%. But, you've got your Apple's, Google, Microsoft, Tesla, all of those that have had still monster runs, and they have pretty much single-handedly lifted the whole index. So the question is that going to be the same trend? And given the valuations of where they are now, like, Apple's pretty much near 3 trillion. Is it going to have another 20% move, pushing it to 4 trillion? Then again, I mean, that's the question. It'll be interesting, but I don't think this year on an index basis, there wasn't much pain. And I mean, even with this small little sell-off, it's 3-4%. I mean, the S&P hasn't got below 4,500. I mean, the NASDAQ. So the question, I mean, on an index basis, the pain hasn't really been that much. So is it going to be as plain sailing next year? I mean, I think the end of this year sort of is might be painting the picture for how it happens next year. We might see a lot more volatility. And it's going to be very interesting. But with more volatility, more opportunities, I'm looking forward to it. That's what you want. So, as an option strategist, although I do my own dabbling in just buying the outright shares, but with the options, you can have a lot more flexibility in your strategies when you have the premium being a bit higher. So
why don't you talk us through a few of the trades you've done this week?
Yeah, so I mean, last week, the last podcast, we did talk about a couple of the trades we did before. This week, I've done two trades so far. I guess it's only Tuesday, but with Tesla's had a pretty big move. Down up from a high of 1,200. Actually reached a low of about 890 today, and we sort of bounced back hard, and we're trading around 940. And so I wanted to play a bit of a bullish bias, but have it slightly delta neutral. And with the IV where it is at 56, I thought I was going to sell an 850 put and buy the 840 put, and then sell the 1175 call and buy the 1180 call. So basically, I've got $10 risk on the downside, $5 risk on the upside, and the total credit was just less than $3. So my max risk to the downside is $710, but to the upside is $210 if it breaches the 1180 call, and that's for the Jan 21st strike. I believe they've got earnings the week after, so I wanted to play it before they have the earnings, where you can obviously have the big move. So IV is pretty high, and I'm just hoping that just the market in general calms down a bit and we get a bit of an IV contraction, and hopefully I can take about, I'm looking to take about 30 to 50% of the max credit. So that's what I'm trying to do with Tesla. And with DraftKings, I looked at this one because we were trading above 62. And I think DraftKings is synonymous with a lot of these Russell stocks that have been absolutely destroyed. And I mean, it went to a low of around 26. And I think this 60% move from the high, not that I really think is great fundamental play, but I do feel like in general, if we have a bounce in the Russell and some type of rotation back to the small cap index, we could see a bounce in DraftKings, and the IV is 66. So you're getting, so currently, I forgot where, I think DraftKings just closed today above $30, and I put on this trade earlier today, and I managed to take around, average of around 65. So about a third of the width of the strike for a max risk of 135. So selling the 28 put, buying the 26. I think DraftKings went to a low of around 27. So I'm hoping that the low stays in place. And if it does, then, this should sort of contract nicely, the IV. And so we'll see how that goes. There's no earnings, I believe, before the 28th. So we'll see if we start the year off on a good note. If we have any sort of rally and DraftKings goes to 32, 33, I think that 65 will go down to about 30, and I'll be out. But just a recap on the previous trades that I noted on the pod. Alibaba was one of them. He had a massively high IV rank, and it's actually still really high right now. It's about 85, which is still very high. I done a 122, 120 put, 138, 140 call, and I took in 126. Right now, Baba today had a good day. It rallied about $6, which was very, very helpful. So I think it went to a low of like 113, 114 yesterday. Closed at 123, and I could close out this trade right now for $1.04, which would be about $22 profit. But I'm just going to hold this. I've got still about 15 days or 18 days to expiry. So I'm just going to hold this out a bit more. Hopefully some of these Chinese stocks can get a bit of a tailwind, and this can push it back towards the 130s, which I think will push down this spread to about 70 cents, 60 cents, and I'll be out on that. So I'm still currently in this one, but the DocuSign one, I took in a 155 credit for a 345 risk, selling the 130 put and the 125, buying the 125 puts. And right now I'm trading at 35 cents, but when it got to 50 cents, I just took the profit, took $1.05 on that one. So that one worked out quite good. The DocuSign rallied from about, I think, 140 at the time, currently 156. The IV has contracted quite a bit. So that ended up being a good trade. So I'm out of that one for $1.05. And Tesla. So this is your trades. So walk us through what you did.
Sure. So I have a slightly different strategy to Raj in terms of how I play my options. So I sell naked puts. When you sell naked puts, in general, you want to do it on companies that you're happy to own on the long run. So this is why I do it with Tesla, because I'm always happy to, add a couple of hundred more shares, but it has to be at the right price. So obviously, thank you to Papa Elon for selling shares and not, disclosing too much information apart from the Form 4s that go out on the day, or, within 24 hours after he sells. But he's not putting too much on Twitter about it. So we don't know when he's looking to end his year sales. And, it seems like institutions are not ready to buy in until he actually finishes, or they've got at least a better outlook on what his sale pattern is going to be like. Let me just go into the trades that I made. Last week, I sold 1,865 23rd December 21 put. Got a credit of $15 for that. Closed it out today for 90 cents. So that was $1,490 of nice profit there. And another one was a 900 strike, 23rd of December 21 put that I sold on the 15th of December. That credit was $31. and I hope to close tomorrow or Thursday. The current price is 18. The guide I normally have is to sell when the trade gets to 50% profitability. Sometimes I let it run if it's looking, very likely it's going to expire worthless. It's been so volatile over the last few days that with the 865 put, I just let it close.
It's no point trying to get the pennies, if we've got
exactly. Also, for people who don't know too much about, selling naked puts, it's also a good way of lowering your cost basis on a stock. So in the example of the 865 put, if Tesla closed below that on 23rd of December, my effective price would have been 850 times 100 shares. So it would have cost about $85,000 instead of 865 because you have to minus the credit that you get on there. So it's a good way of potentially either just using it as an income-based strategy if you're happy to buy the stock at that specific price. But if you're not, then I would not recommend doing this type of strategy. It's much more prudent to use something along the lines of the strategies that Rajan has, which has a defined risk, which these type of trades do not have a defined risk. You can the risk is for Tesla to go all the way to zero, so you could lose a lot of money doing that. So you really need to do it on stocks that you have conviction in and buying at a good price.
So that's what we've been up to this week. We've got, you're seeing the volume sort of tick down a bit now as we head into Christmas. We've only got 2 days left now, so it'll be interesting to see whether there's follow through from today's rally to tomorrow and the last 5 days of the year. So we'll see how we end the year. Do we end up on a good note or not? I hope we have a bit of continuation and just a bit of contraction, because I just need some of this Ivy rank to go down a bit so I can sort of lighten my book a little bit. So we'll see how it works out, but it'll be interesting.
So Rajan, what's your play in terms of small caps? I know you're, quite deep into researching those.
The thing is that, in this last pullback, I found it hard to sell some of these stocks that I've got. Some of them, to be honest, have been a real pain in the ass and they're quite big. And the thing is that, shamelessly,
70% downs.
Shamelessly, as a bag holder, I've just turned into a bag holder, basically, right? And the thing is that the thing is that I did take a loss on a couple of it. I was actually long Alibaba shares, and I just got out. That was I just wanted to. Although I'm long some options, I've got some option plays on Alibaba. I just wanted to get out of China. My China exposure is virtually zero now, and because the thing is that with China, you're basically betting against the government. And the thing is that there was comments today that China, the government will continue their regulatory crackdown through 2022. And so that's just another headwind in the stock. And to be honest, I'd rather just be out and then put that capital elsewhere. So in fact, my BABA position that I had the moment I got out, straight away I bought some shares in DocuSign after DocuSign got smashed 40%. But I think DocuSign has a great product. So, around 140, I've got it about 140 at that price. I think, around 250, where it was before earnings, 260, I wasn't interested. But at 140, I think there's value. And again, I'm not a long-term holder of that, but if it goes anywhere back towards around 200, if that does happen, that's great. I'm out. But the thing is that I've got that, accumulated a bit more in Sophie as well. Just had a 30-40% pullback in Sophie. Pretty much every small cap stock has had about 30-40% pullback. So against PayPal's been his nemesis, has been mine too. It's been one hell of a bad move in PayPal, and I think there's a lot of people caught in there. So I'm just slowly getting a little bit more in that, but now I'm just holding it like with everything else. But yeah, that's it. Just what I had, it just added a little bit, and the real garbage I just got rid of, like BABA. Although BABA in itself, I think, is a great company. I think with China, the government and what they're doing, you're not playing a fair game. It doesn't matter what analysis you do for the company, it makes no difference when China cracking down like there's no tomorrow. So sure. That's why I just got out that one. Definitely. So that was me.
Yeah, I feel you. Yeah. I'm still bag holding on the BABA. and PayPal. And yeah, there's, I dedicate about 1% of my portfolio to a lot of these spec plays, and some of them are down like 70%, but obviously some of them are up like, great. I took some juicy tendies on Lucid and Matterport. Those were definitely those were amazing plays that paid for all the losses that I've had on these small ones. But you know what, I like to dedicate some small amount to those those small cap stocks, which I don't know, it makes the market fun as well, just to see how they're doing. But when you see all this red on
the thing is that I've got a bit of Walgreens. Walgreens is what keeps me down to earth, with a little bit of a juicy dividend. But then other than that, just go for these. I think potentially that could be a good company. But again, this market's gone well ahead of itself this year. You've had too much pumping and companies that have been way above their fundamental value. And then what happens? We have now been dragged into those valuations thinking that they were normal when really there wasn't. Yeah. So the thing is, we could get a big multiple contraction continuing. But some of these players, they're trading at like 1x revenue. So I think some of these stocks are, pretty attractive. So we'll see how it all works out.
So what is your thesis on all of the money that's been printed? That was one of the narratives, whenever we were hitting all-time highs, everyone was saying, there's just so much money flowing around. There's so much money flowing around. We'll never drop that much. And then we get completely whacked, right? Which seems like a sustained whack for longer than I remember it for a while.
For a long time. I think since last year, May, we haven't had a sustained downturn as long as this. And bear in mind, this ain't even long. It's only a week. Normally a downturn lasted about a couple of days, and then this is lasting a week, and then everyone's going, oh my God, everyone's feeling a bit jittery. So the real question is that, again, we have not seen a meaningful, consolidation or real downturn for about a year and a half. So, we have to just see how this all sort of comes out. And again, we've got a lot of macro factors. Omicron is one of them, but really, as rates start to rise, as the pace of the rate rises, and it's the pace of inflation as well. And if inflation continues to rise and the supply shortage bottlenecks continue to persist, then I think there will be a lot more headwind. Because let's take Apple, for example. In the last earnings, they cited supply chain issues for their shortfall. They actually didn't have a great earnings, but funnily enough, their shares are up almost like 15-20% since their last earnings. And the question is...
the safety play, right?
Yeah, this is it. So the thing is now, going into next earnings, Q4, first few weeks in January, Apple was normally one of the reports in the second week. And, along with, Tesla and all of those. And we'll just see how much, again, this supply chain has been a factor in their earnings. And if it's going to be a continuous thing where people just can't get the parts, you can't just meet demand, then... you know what, then I think we're in for a bit more of a sustained downturn. So I think this next earnings season will be very, very telling, because, we've seen a lot of CEO commentary before saying that bottlenecks are easing, but now, you're seeing a lot of these airlines, number one, as expected, they're seeing a bit of a hit to a bit of a spike in cancellations. You've seen like General Mills reported today, they missed earnings, and they raised prices, but they couldn't raise it fast enough compared to their cost of goods and labor and everything. And the thing is that if that is the overriding theme going into next earnings season, then I think we could get a healthy pullback. But I guess we'll find out how that works out.
We'll see. I still think that with companies like Apple, they just have such large margins, right? And they obviously have a huge moat. And I think companies such as Apple, even Tesla, the ones with massive margins, right, that they can weather the inflationary storm and supply chain bottlenecks because the margins are just so high. I think those are the ones that people are going to chase and still pay a premium for those. But again, anything can happen in this market now. But, even though looking at my portfolio, not a happy man, over the last week, a few people in a couple of the chats we've been saying, it's like, this is good. This is like, this is healthy. It weeds out a lot of just
weekend.
Silly. Yeah, exactly. The weekends. But, also, this has all been...
at the fraud, because there's a lot of crappy companies out there that have been valued stupidly. So that's really that.
Yeah, 100%. Definitely. Yeah, it's been great getting back onto the pod.
Hopefully we'll get one in before the start of the new year. And
just one quick favor, if you guys could like and subscribe, it will really help us out, and maybe even leave a comment below on what your plays are in the coming few weeks. So yeah, we'll catch you guys in the next one.
Okay.
Peace.
Peace.